across to London now, and the markets are open, and there appears to be a modest rally. I'm joined by James Shugg, senior economist at Westpac International Bank. Well, James, everyone is talking about a relief rally. How convincing is it?
Good evening. Look, well, it was a very convincing rally in the sense that we haven't seen such a gain for many years on the US stock market. I think I need to clarify a few things. It wasn't a promise that the Fed would keep interest rates close to zero for 2 years. They said they anticipated that economic conditions would warrant that. So you know, things could still change.
So, for instance, if they came through with their Jackson Hole conference at the end of the month with some serious stimulus, some serious quantitative easing, that might change their suggestion that they were going to keep interest rates on zero.
Well, look, our view at Westpac is they will indeed keep interest rates at zero, and that there will be eventually a further round of quantitative easing. We've had that view ever since they announced the second round of quantitative easing, because we didn't think that would be enough, and I think that's kind of proven to be the case. All I'm saying is the markets perhaps have been a little bit too optimistic about the statement. The Fed is certainly not going to be rushed into any further stimulus. There are increasing risks, they believe, on the inflation side if they do further quantitative easing that might more than offset any growth benefits. Also, I've got to add, there are still some pretty big problems in the global economy that are yet to be factored in by markets at all. We think there's a risk that Chinese could potentially slow their economy down too much later this year, and the Japanese energy problem is going to become a disaster for that economy heading into 2012. So if we had a Chinese problem, the Japanese problem, the US economy remaining very weak, and the European sovereigns defaulting all at around the same time, believe me, markets will keep falling.
Interesting what you say. When do you think these issues of China and Japan are actually going to catch the eye of markets?
It's hard to put a timing on it, but certainly by the next summer, we're expecting Japan to be having severe power shortages. They're shutting virtually all the nuclear power stations. They haven't got replacements ready. The energy prices are going to rise. It's going to be a significant issue for inflation in the Japanese economy, and also for the banks who are heavily exposed to the utilities, which are going to be losing money hand over fist. So watch out for Japan as another big risk going forward. All
right, well, back to Britain this morning. The Bank of England has released its inflation report. What does that say about the British recovery?
Well, they've downgraded their growth forecasts, unsurprisingly. They've actually lifted their short-term inflation forecast because of higher utility bills, but expect that over the medium term, inflation will actually be below target. In other words, the Bank of England is edging towards potentially putting in place further stimulus. Nothing to do on interest rates. They're already close to zero here. So that will mean further quantitative easing from the Bank of England as well. We think probably in the first quarter of next year.
The Italian market looks iffy at best. I mean, just thinking about the size of the Italian bond market and how deep the pockets of the ECB are, it all looks pretty alarming.
It is. I mean, if Spain or Italy were to lose access to financial markets, it would be a calamity for Europe and the banking system, and indeed have a significant impact globally, I suspect. Maybe not quite as big as Lehman Brothers, but certainly of a similar magnitude, perhaps. That's why they're going to do all they can to prevent that from happening. And that's why the European Central Bank has been buying the bonds of Italy and Spain and holding down the bond yields. They've fallen more than 100 basis points this week so far.
And also that seems to have an impact for Germany too. I see now that the cost of insuring against default for Germany is now more expensive than for Britain.
Look, Germany is going to pay for it one way or the other. They can either simply make a grant to these countries that have got problems in terms of their access to financial markets, which German voters will never vote for, of course, or they'll pay for it in terms of weaker economic growth, higher interest rates on German bonds, and probably even the need to bail out the Bundesbank and indeed private sector banks in Germany at some point when the defaults actually happen. It's a real mess in Europe.
Well, quite. And I see also Commerzbank, Germany's second biggest lender, today says its quarterly profits slumped 93% after writing down the value of Greek bond holdings. Was that a surprise?
No, and don't forget, we've still got a bunch of other government's bonds that the German banks are heavily exposed to that probably haven't yet been taken account of fully in terms of the hit to the balance sheets. And so, look, there's been a little bit of a hiatus in the last couple of days in terms of focus on the European problems, but it's all going to come back to bite us very soon, probably before the end of this year.
James Shugg, thank you very much for joining us tonight.
Okay, thank you.